Going on, everyone? Bruno Quintella here with New Direction School, and today we're going to talk about the income approach. Now, this is for real estate appraisals, and the income approach is one out of three approaches to value. All right, there's three approaches to value. One of them is the sales comparison approach. The other one is the cost approach, and today the income approach. Now, out of all the three, this is where everybody gets a little confused about things. So to make it simple, before we dive into this, right, it's we have the sales comparison approach, and the sales comparison approach is what we traditionally know as comps or CMA. Is when we look at other properties, right, and what they sold for, and the value of the similar properties will determine the value of yours. So that is used both in appraisals and also used in real estate by salespeople. So we salespeople traditionally do CMAs, comps, right? So free valuations, while appraisers do fee or paid for valuations, right? So those are called appraisals. That's comps. In cost approach, we're going to look at the cost of a building, and that will be based on how much it costs to reproduce the building or to replace the building. And with that being said, reproduction is bringing it back to everything with original material, making it again to look like it was manufactured today. All right, so we've heard of those as OEM, using original equipped parts from the manufacturer, right? So aftermarket, right, and I'm just trying to relate to something that most people know. Aftermarket are those parts that are not original, but serve the same purpose, all right? So an older building would have, for instance, copper pipes. Today we have flex pipes or PVC pipes. So we replaced with something different. So a building that needs to be replaced, we need to figure out the cost approach. We're not going to use copper pipes to come up with a value. We're going to use today's construction methods to come up with a value. So it's called replacement because we're using, again, today's methods. The third one is the income approach, and that's, again, the third method of approach to value. And we use this one mainly in income producing properties. All right. We've probably heard the term cap rate, right? Or rate of return, RR or ROI. So these are very similar terms. You've probably heard these, and when you heard these when you've heard this for real estate, we were talking about the income approach. We were talking about how can we determine the value of something based on income. And why would we use this one? Because the other two methods do not apply, right? There's not many comparable sales to work with, so we need to figure out another way to determine the value, right? And that's what we've done. We went based on the income that the property produces. Now, let's go dive right into this. There's a couple key things you need to know about income approach. And these key things start with PGI, which is potential gross income. The next thing is, and these are the steps, by the way, the next thing is loss, right? And we're talking about vacancy, not being 100% occupied, or rent collection, you haven't gotten paid this month or next month or whatever. The next thing, once we've dealt with that, the next thing is expenses, right? And then it brings us to what's called NOI. And NOI is the number you need in order to figure out what the value of this property is. Because I told you it's determined based on income, right? So what is NOI? It's net operating income, right? So I want you guys to think of your paycheck. Your paycheck, there's the amount that you issue to home, and then they start deducting things, right? The first thing we're going to go over, guys, right here, is the amount you wish you could get. And this is the PGI, okay? PGI, potential gross rental income. So potential gross income. And PGI, we are assuming that the building is 100% occupied. 100% occupied. Now, as I ask all my students, and I'm asking you guys now, everybody here now is, are we always going to have it 100% occupied? Or let's make it to the other example I was giving you. If you work somewhere, are you going to work all the days of the year? Is there a chance that you have to miss one day to take care of some paperwork, go to the DMV, go get your passport, go handle something that's important, or maybe even get sick? Not all employers provide, not all job types provide with sick days. So there's a chance, and we need to always calculate this into our monthly and yearly budgets. There's always a chance of missing out a day, missing out a payment, right? So that's what we call vacancy, so not being there, and rent collection losses, not being able to collect the money that's owed to us. So we're going to go here, and we're going to deduct loss minus the loss. And that was vacancy or collection. So either vacancy, it's empty, or the rent collection, so minus loss. And once we do minus the loss, right here, what do we get to? We get to something called effective gross income. And what is the effective gross income, or EGI? Right? The effective gross income is the amount that we are assured, kinda, right? We're assured kinda that we will collect. It's not the 100%, but it's deducting what we know as market experience. We're deducting the vacancy to give us the effective gross income. So if vacancy was, for example, let's say, put some room here. Let's say, for example, vacancy was a 5% vacancy, then the effective gross income would be 95% occupied, right? And this is the number we need to work with because it's what we can expect to come in, right? So now here comes the other question. When you, relating back to your paycheck, when you collect your paycheck, let's say you did not work 2 days. So it's the gross income minus those 2 days gross, right? Is that the amount that comes home? That's still not the amount that comes home. Of course not, because we still have Social Security, disability, family leave, the bunch of other acronyms there that you don't even know what they are. Deduction, 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 deductions. And then comes what you really need, which is the net. What do you take home? What comes to your pocket? Only thing you can really count with, right? So that means we had to deduct for this purpose, we had to deduct expenses. And what are expenses? I call this pretty much the cost of operation. So these things in reds are the things that we need to, in red are things we need to deduct, right? The cost of operation, the cost to keep the lights on, right? Which is utilities, employees, if you have them, like a property manager or superintendent or something like that, right? Your regular expenses, taxes, right? Insurance, all that goes into your expenses, even if you, the homeowner or the property owner, manage it yourself. So we have to include a salary for somebody to manage the property, okay? So once we deduct that from our calculations, we now reach the number that we need to figure out the value of this property, which is the NOI. And NOI means net operating income. Okay? This is what we need. This is pretty much the initial formula to figure out what you need to calculate the value of this property. Now, just want to put this here. Nice colorful things. The first step is PGI, potential gross income, minus what we know it's the average market loss that we have in this type of property. Okay. Step number 2 is EGI, effective gross income, which is the outcome of these two, right? And we deduct the expenses, the cost of operation. And we reach what we really need, which is NOI. All right, so 2 steps here to get to NOI. All right, so guys, net operating income, we got that. Let's move forward. Now, how does the NOI relate to the value? Okay, so just like all the other comparables that we do with sales comparison approach, for instance, right? All the other comparables are based on recent sales, right? So we're going to go and look at what recent sales did in the current market, and we're going to try to figure out what is the cap rate that they brought, because the cap rate that they brought is what's going to determine the value of my property. If it's the average cap rate of 6%, then that's what I need to use against this number. If it's an average cap rate of 8%, then that's what I need to use. If it's 10%, then that's what I need to use for this type and kind of property. All right. So it doesn't get too complicated in the state exam. What it might happen, I'm going to give you, just so you guys know more or less how it happens, I'm going to give you 2 examples real quick, right? But I'm going to put the formulas here first. And the formula is very simple. NOI times cap, and we'll talk about what cap is in a second, which is a cap rate, equals value. All right? So if they gave you the numbers, we got to NOI. And sometimes in the state exam or school exam, they give you the actual NOI. They don't give you all this stuff, right? Sometimes they do, and that's why I put it out here so you know, right? So the relationship is between the NOI and the cap gives you the value. If you have, okay, if you guys have the cap and the value, or if you have the value and the NOI, then you can still calculate things. So again, go over this. Apologies, I made a quick mistake. Sorry. It is what it is. Divided. Corrected on time. All right, so it's NOI divided by cap. All right. If you had, let's say, NOI and you had value and you're trying to figure out cap, it's exactly the same. You divide the net by the value, right? You divide the net by the value and you get the cap rate, right? What if you have cap rate and value? Well, it's value times cap equals NOI. Okay? The value times cap equals NOI. So these are the variables of the formula. Again, don't go too much into this. I'm going to give you examples to make it simpler. But these are the variations of the formula. Without this, nothing matters. Right? I'll tell you right now, for the school or state exam, without NOI, nothing matters. But these are the variables, right? So let's dive into a quick example. So let's say, and this is the simplest example that I can get you here, and then I'll complicate things a little bit as I usually do. So let's just say that we have a property has a net income of $24,000. This is the NOI. Because every time they say net income, it's NOI, right? The property is currently valued at $300,000 value. The question is, what is the cap rate? So in this question, they will provide you two items, right? And percentage problems, as I'll talk about in most math chapters, percentage values contain three elements. In this case, you have two. Just need to figure out the third. Now, NOI and value is what we have. We're trying to figure out cap. Let's go here. Which one matches, right? Right here. NOI value equals cap. So NOI divided by value equals cap. So $24,000 divided by 300, and this equals the cap. So 24,000 divided by 100, and it tells you that the cap is 8%. All right? So what did we figure out from this? Cap rate. We're going to look at 3 or 4 other properties, let's say. Let's say this is in real life now. So that would be the answer for the exam, 8%. In real life, we're going to look at other properties, right? And they're all listed. So if they're listed, their information is supposed to be there. So we're going to look at other properties, and we're going to see right there, we're going to see the income that they have. So 24, 25, 30, 40, 10, whatever the income. We divide by how much they sold for, and it's going to give us an amount. Let's say it's 8%, right? Once it gives us the 8% average, or 7.9 or 7.6, that means that in this area, this is pretty much what people expect. So all I would have to do now is my property brings, my property brings, let's say my NOI in my property is $25,000. So just a little bit more than that property right there. Okay, we have the NOI, we have the cap rate, and we're trying to figure out the value. What is the formula? Over here, right? The first one, we have NOI, we have cap, we're trying to figure out the value. So what do? We divide by the 0.08 or 8%, and it's going to give you a value. So this is cap. And what we have is 25,000 divided by 0.08. And my property obviously is worth more than the other. Value. So in real life, these are two variations of the question. These are two variations of real life. What could happen is you look at comps, and the comps determine that 8% was the comparable cap rate, right? We apply to the income that our property brings, and now we know how much our property is worth. All right, let's go into a little bit more complicated question. In this question, and let's see, in this question, I had wrote some numbers here so I can give you as an example. In this question, it says the property brings $300,000, right? This is the PGI, right? Brings $300,000 if 100% occupied. So I'm going to put here if 100% occupied. And by the way, guys, in the state exam and in the school exam, they give you a piece of paper, right? So you're going to be able to take notes from the question that's being presented to you. I strongly encourage whatever you see on the computer, take it, dump it into the piece of paper, and from there move on. All right? It's one of the easiest ways because, like I showed you in previous videos, there's stuff that you can just cross out altogether. But in this question, $300,000 that it brings if 100% occupied. Now, based on market experience, this property has a 5% loss. So vacancy loss, right? 5% loss. And also the expenses here in this property, sorry, the expenses are $35,000. $35,000 in expenses. These are the operating expenses. We definitely talked about this, right? So the question is now, what is the NOI, right? But what if they're asking, what is the, what do you call it? What is the value of the property if the cap rate is 7%? Okay? Value. Okay, so now we complicate it a little bit more. Because in the previous example I gave you, all I did was NOI and value. What's the cap? In this, a different type of question, they have the potential gross, they have the vacancy loss, they have the expenses, they have the cap. What is the value? Right? Remember, there's two steps for the number you need. First of all, what is the number you need? NOI. How do we get to NOI? We have to calculate the losses, right? So what we have is very simple. It's 300,000 minus 5%, and this equals 285. This is your EGI, effective gross income, that we just mentioned earlier, right? Minus, don't forget this, we need to minus again, $35,000, right? These are the expenses that are being deducted. And that tells you guys that, sorry, where do I have it? Oh, here we go. So I'm sorry. So that tells you that this property brings an NOI of $250,000. This is the NOI, and this is annual. Okay? So that was simple. 300,000 because that's what they told us if 100% occupied. 5% loss. That's what we expect from vacancy and rent collection issues, right? That brings us to EGI, effective gross income, so $285,000. Then we deduct the expenses, the cost of operation, and we reach the NOI, net operating income. Now the question was, let me just bring this down here, 250,000. Okay. The question was, what is the value of this property? So if the cap rate, right, cap equals 7%, all we have to do is divide. Okay, that was the formula, wasn't it? Let's just confirm. NOI divided by cap equals value. NOI divided by cap equals value. So what do we have here? We have 250,000 divided by 0.07. This property is worth $3,571,428. This equals value. All right, guys. I hope this is simple. I hope you guys understood. Trying to break down as much as I can to help everyone achieve success in the school state exam. By the way, this is real life. This will happen to you guys. So keep this in mind when you're out there. All right? I hope you guys enjoyed. If you have any further questions, please submit them to instructor@newdirection.school. And if you know anybody that wants to get into the real estate world, wants to get into a real estate career, I'm in New Jersey. So make sure you send them to newdirection.school and they can get a New Jersey real estate license. I'll see you guys in the next video.